Hello and welcome to the fourth of our lecture recaps for SEMA F3 Financial Strategy. Remember, these are only recaps of the lecture. I go through this very quickly just to give you an idea of what we covered and to remind you of it. So, investment appraisal then. Well, there's stages in investment appraisal, the first of which is identifying your investment opportunities. So you'll do this to achieve your objectives and to assess the business environment. Those are two things that you're going to do when you're identifying those opportunities. You'll then screen your proposals to make sure you're making effective use of your resources. You'll analyse and evaluate the investments. You'll use such things as NPV and internal rate of return, and we'll look at those in due course. You'll then approve them, of course only if they are positive. You will then implement the investment, monitor it and review it. After that, you will conduct a post-completion audit. After the project is finished, a post-completion audit. This is to ensure that managers are careful in the future to evaluate management and to evaluate future projects effectively, to learn your lessons. So those are the stages in investment appraisal. We're going to look at the analysing and evaluate stage. So we may do this using the accounting rate of return. This is based on accounting profit, i.e. profit before interest and tax, but taking account of depreciation, over the average investment. The average investment is the cost of the project plus the residual value divided by 2, and that's simply a mechanism for getting the average value of the investment as it would be shown on the balance sheet. We did a little example of that on page 79, have a look at it. So is this method useful? Well, the strengths are that it's understandable and simple. However, the weaknesses are it disregards the timing of the cash flows. All those cash flows could have come at the very end or the very start of the accounting period you're looking at. It uses accounting profits, not cash, and we know that accounting profits can be manipulated. It's again expressed as a percentage, which means that it doesn't take account of the size of the investment. It's just a percentage gain on whatever the investment is. And it ignores the life of the project. It doesn't say how long the project lasts for. So that's the accounting rate of return. So what if we want to use cash flows to eliminate the problem of profit being manipulated? Well, why would we do this? Well, again, it's hard to manipulate. It's a more accurate appraisal, and it leads to better decisions. Which cash flows will we use? Well, remember our relevant criteria. There were 3 of these. It must be future, i.e. not a sunk cost already incurred. It must be incremental or additional, i.e. additional costs. And it must be cash. So accounting mechanisms such as depreciation are not relevant. We did a little example as to how to apply the criteria. Have a look at it on page 72 of your notes. This brought us on to our payback period. This is simply the period taken to recover the initial cost of the investment. And you can have a constant cash flow, or you can have an irregular cash flow, and we looked at examples of both of those. Make sure you know how to do both of them. So is it useful? Well, the strengths are that again it's simple. It minimises the risk because you're recovering your investment as quickly as possible. It maximises liquidity because again you're recovering that investment as quickly as you can. And it's based on cash rather than accounting profits. Any weaknesses then? Well, what do you do after the payback? Is there future cash flows after that? Who knows? The payback doesn't allow for that. Profitability, we don't really know. Again, we're just concentrating in payback on getting our investment back. And it ignores the time value of money. Time value of money then, this brings us on to discounted cash flows. Discounted cash flows allow for inflation. So a couple of definitions. The real value ignores inflation. The nominal or money value is inflation adjusted. And we have the relationship between those as the money equals the real times the inflation. And our little equation was 1 plus M equals 1 plus R times 1 plus inflation. So we did a couple of examples on that one. Make sure you understand that relationship. which brought us on to say that the present value, i.e. the value now of a cash flow that you're going to receive in the future, is calculated as this: the future cash flow over 1 plus the discount rate as a percentage. Now the discount rate is calculated as the future cash flow times 1 over the discount rate times n, but we use our present value tables, which you'll be given in the exam. An annuity then is used if you have a constant cash flow over a number of periods. It's the second of the tables in the exam. If you have a constant cash flow for several periods, use your annuity tables. It'll save you a little bit of time. And if you receive a cash flow forever, i.e. a perpetuity, it'll simply be the cash flow over the interest rate, which will give you the present value of that perpetuity. This brought us on then to our net present value calculation. Now our net present value calculation basically is our initial investment as against the present value of the project cash flows. If all the cash flows that you're going to receive brought back to today's value are more than the investment, you will receive a positive net present value, and that will lead to an increase in shareholder wealth. Those are the key thoughts behind net present value calculations. So how do we do it? Well, we set out all our relevant cash flows. We use a discount rate, which we will either calculate or be given in the exam. It will be our present value of our inflows versus the present value of our outflows, and hopefully the inflows exceed the outflows. And we have a pro forma in our notes for setting out these relevant cash flows. A couple of assumptions we need to make. Well, our initial investment that we make is made now in period 0, so we don't need to discount it because it's at today's value. Our cash flows then occur at the end of the period in which they occur, so you don't have to split it up. If the cash flow occurs 6 months or 7 months into the period, we just assume it occurs at the end and apply the full discount rate for that period. So, approaching a question on net present value. Well, first of all, we set out our pro forma. We remember that there's a period 0, and we add an extra period at the end for tax, because tax is usually paid the year after it's calculated. So that's the thing to do. Check if your tax is included and use the pro forma tax calculation which we went over in class. If there are inflation adjustments, you've got to inflate the figures and check that you're using the correct discount rate, which we will come to. Then just simply go through the question line by line, make sure you've set everything out and make sure you've covered everything. Working capital then. If we have working capital, it's invested at the start of the project, so we'll get a large investment of working capital at the start. We then increase or decrease our working capital throughout the length of the project. Now what we have to do is only account for that increase or decrease in our net present value calculation. You'll have invested the bulk at the start, and then you'll either increase it or decrease it by a certain amount over each period. And then all of the working capital is returned at the end of the calculation. And we did our little example of that. We also looked at our tax effects. Remember that investments will receive tax benefits in the form of writing down allowances. So firstly, our tax on our profits is calculated simply as our profit times our tax rate, and it's normally payable 1 year later, so remember that when you're doing your calculations. Our written down allowances then, it's tax relief on the capital purchase or the capital investments. We have our pro forma, which we set out in class to make sure that we know what the items that go to the net present value calculation are. And when the item is sold, remember, we have a balancing allowance. Okay, so that's a very quick run through investment appraisal. Have a look at your notes, make sure you can do the examples, and I'll see you at the next lecture.